Starting the live stream right now.
Yep, you're good on both.
Good afternoon, everyone. We'll go ahead and get started. I'm Zach Myers with the Center for Dairy Excellence. Thank you for taking the time to join our Protecting Your Profits webinar today. If you have questions, please type them in the chat box by clicking on the chat box icon at the bottom of your screen and type your question. I'll be monitoring that through my portion of the webinar and Phil's as well to get those questions. My goal today, as every month, is to provide an overview of the current dairy market and to review risk management opportunities. This is all public information, and while I may express some opinions, these are not recommendations. So moving into it with just the same agenda, follow the same agenda I normally do, and then turn it over to Phil for his presentation on uneven and uneasy dairy situation and outlook. So with that, September milk production and cow numbers at over 18 billion pounds. U.S. milk production was up a slight 0.24% year over year in September, after being up 0.6% in August after August provisions were made in this month's reports. So the milk production continues to milk production growth continues to decline. So has slowed down considerably since earlier this year when it was increasing 3% and 4% at times year over year. U.S. cow numbers were up to 9.42 million head compared to last September's 9.4. However, for the fourth month in a row, there was a month-over-month reduction. September cow numbers fell 25,000 head compared to August revised 9.447 million, and is 85,000 head less than the multi-decade high of 9.507 in May of this year. Increased cow numbers were solely responsible for the slight increase in milk production, with production per cow down about 3/10 of a pound compared to September 2020. Pennsylvania cow numbers are down about 7,000 from last year, and the milk output per cow was down about 4/10 of a pound to 64.4 pounds per day. And as a result, Pennsylvania milk production this September was down about 17 million pounds to 798 million pounds. And the 475,000 head of cows in Pennsylvania Pennsylvania's been able to maintain that number all for every year so far, every month so far this year. So this will be the ninth month in a row that we've been able to maintain 475,000 head. Butter stocks shrunk during September, while cheese and non-fat dry milk stocks grew through July and August, and August and September. September butter stocks finished the month down nearly 14 million pounds to 330 million pounds. September cheese stocks grew about 105 million pounds to finish the month at 1.5 billion pounds in stock. And August powder stocks were up about 7.7 million pounds to 285 million. So moving on to some dairy product prices at $1.75 per pound. September butter price is 20 cents higher than last year and continues to be a significant discount compared to international prices, with the global dairy trade at $2.70 and the EU at $2.22 a pound. Cheese price is down considerable 86 cents compared to last year, and is also a discount compared to global dairy trade at $1.94, and virtually the same as the EU price at $1.73. At $1.35 per pound, non-fat dry milk is 28 cents more than last year and is slightly lower than the GD price of $1.50, but 14 cents higher than the EU price. So with international milk production down, supply for powder is tightening up, and international prices are expected to rise. And this certainly should give the U.S. more export potential on the powder side. So we'll see what unfolds as the world supply declines and the U.S. continues to experience congestion at major ports. August butter production was down about 2.5 million pounds compared to last August, 148 million pounds. And cheese production was up about 43 million pounds to 1.14 billion. August powder production was down almost 4 million pounds compared to last year to 122 million pounds. Disappearance was sort of mixed a little bit, but still shows some good signs, especially with butter. Butter disappearance was up 19% to 189 million pounds due to increased domestic use and exports. At nearly 448 million pounds, American cheese disappearance was down about 2.5% because of a 13.6 million pound drop in domestic usage, which overwhelmed a 2.7 million pound increase in cheese exports. Other style cheeses are up to 742 million pounds, 7% more than last year, driven by a 44 million pound increase in domestic use and a 4 million pound increase in exports. Milk powder disappearance was down 16.5% to 211 million pounds, driven by a 63% decrease in domestic use that overwhelmed a 15% increase in exports. So moving on to current futures prices. Class 3 milk futures for the next 12 months as of October 22nd closing prices were up $1.09 compared to this time last month. The Class 3 futures price averaged $18.58. October Class 3 was the low at $17.87 and then jumps to $19.61 in November before dropping slightly in December. Then it levels out into 1830s and 40s through next summer. The current Class 3 12-month average price is about a little more than $2 more than the 5-year average of $16.49. Class 4 is also improving. Class 4 price for October is currently the lowest price for the next 12 months at $17.87, and it climbs to $18.65 by December, and then levels out in the 1820s and 30s through the next summer. The Class 4 12-month average increased to $18.26, which is $1.07. It's $3.46 more than the 5-year average price of $14.80. So these are Friday prices, and I know yesterday the market was down, especially in Class 3, quite a bit for these same much. So I didn't, when I put this together, of course, it was before then. So these prices have come down a little bit, but I haven't run the numbers to see how much the difference it made in that 12-month average. So moving on to exports before we get into some of the risk management notes that I have. 198,032 metric tons of dairy products were exported in the month of August. This is up 13% from last August, and we're valued at almost $670 million, which is a 21% increase from last August. And if everything stays the same and we continue to have good exports and our price stays up, then we're on track to set a volume record again for the second year in a row, and perhaps we'll set a value record as well, which the record holding year for that is 2014. So we'll see what happens. So moving on to dairy margin coverage. August margin was announced at $5.25 a hundredweight. This triggers a $4.25 indemnity payment at the 950 coverage level. 3,000. This equates to roughly 3,300 per 1 million pounds of production history. Up to that 5 million pound cap. Annually, that equates to right at $19,800 per 1 million pounds of production history, and is a net benefit of $1.83 so far for the year after premiums are paid and the 5.7 sequestration fee is removed. The September margin will be announced Friday after 3 o'clock after the ag prices report is released by the USDA. The DMC decision tool is still unavailable for feed price projections and trigger price projections. Still waiting on the rules to be published on the feed price change, supplemental production history, and the 2022 enrollment period. And I sort of feel like waiting on the rules is the last two bullet points there, I think, are related. I think once the new rules are released, then that decision tool will be updated and available again. So on the dairy revenue protection side, the DRP prices shown here are based on October 21st closing prices. When I put this together, that was the last day policies were offered. The cold storage report was released on Friday, the 22nd, and dairy revenue protection policies are not offered on days where dairy production, dairy stocks, or dairy product information is released. So for a 100% class 3, 95% protected price, floors can be set from a low of $17.29 in the fourth quarter of next year to a high of $17.54 in the first quarter for an average of about 34 cents a hundredweight. And first quarter 2023 policies are not offered yet, and I suspect it's due to not enough trading that far out to establish base prices, which is also true for class 4 prices. The first quarter of 2023 are not available. But the 100% class 4, 95% price protected policies on the class 4 side set a price floor from a low of $16.28 in the fourth quarter of next year up to $16.60 in the third quarter for an average cost of somewhere around 37 or 40 cents. The first and then just a little bit of information on poundage covered. If you're following along in the slides I sent out last night, I realized this morning when I was going through it that I'd never updated this slide, so this is different. If you're following along in the slides, you might want to make these. I still had last month's data in there, so might want to make that note if you're following along. But so far, for the 2022 crop production year, 10.5 billion pounds of milk have been covered in the U.S. by just over 1,000 policies. 95 million pounds of milk have been covered in Pennsylvania in 42 policies. And then just a quick update on the Pandemic Market Volatility Assistance Program. The process is still ongoing. There's no new details available yet, and no pay rates have been announced. But last I knew that they were still hoping to get the money into dairy farmers' hands by the end of the year. We'll see if they're able to meet that with things as they're progressing now. So with that, that's all I have. I will now introduce Phil Plourd. Phil Plourd is president of Blimling and Associates, a dairy research and advisory firm that is part of the Dairy.com family of companies that now includes Ever.ag. Phil has been a student of the dairy industry and food business for more than 25 years. A popular speaker, Phil is a host of the Dairy Download podcast. Phil lives near Madison, Wisconsin, where he also serves on the board of directors of the Madison Public Library Foundation. And with that, Phil, I will stop sharing my screen and turn it over to you.
All right. Thank you very much for the opportunity to speak with you folks today. And I'll cover a couple of things that Zach mentioned at the beginning, at the top of the show, but we'll go through them relatively quickly. So first thing first, last year we experienced historic volatility in the dairy marketplace. This year, things have been less volatile, but they're certainly not quiet. So, the noise we saw last year in our markets was pretty huge. 40% volatility in block cheddar, a number we'd never even come close to touching previously. Things are quieter this year, but we're still much more volatile than we were in 2019. In terms of current pricing, Zach went through the numbers. Here's a couple of the pictures. Block cheddar actually down a little bit today again, kind of stuck between 170 and 190 lately. Barrel cheddar had a moment, tried to peak out above the range, but has fallen back this week. Again, a market that's been kind of more 150-ish to 180-ish lately. Spot butter prices had been kind of making a series of lower highs, but yesterday broke out to the upside. We'll talk about butter a little bit. So a little bit more robust butter pricing situation. And sort of sneakily all along, the best market we've had this year, the market that's been in the most pronounced uptrend, has been the spot non-fat dry milk market. We made lows, sort of pandemic lows in May of 2020, and kind of been moving higher ever since. And over 150, the highest price since 2014 recently. In terms of forward pricing, again, Zach presented the numbers. Here are the pictures. January through June, cheese futures, we're doing pretty, bounced up on the milk production report last week, came down on cold storage and lower cheese prices. Butter futures, a little perky here, especially with yesterday's spot price action. Non-fat futures got up to a nice level, but have looked a little toppy. And then when we look at class 3 and class 4 milk futures for the first half of next year, as Zach mentioned, running well above average, with both those strips over $18 per hundredweight. So not a bad forward pricing lineup from a dairy producer perspective. 2021, up to this point, has been about strong milk production. Output year-to-date through September, up 2.3%. The last time we saw full year growth like that was 2014. So we've seen very healthy milk production growth. And even though cow numbers have been moving lower the past few months, on a year-to-date average basis, you were still at the highest level since 2014 when we look at cow numbers. So when we wonder why has pricing been kind of moderate, right? I mean, we've had fairly boring cheese prices, butter prices well below the 5-year average. Yeah, non-fat's been a little perky, but even here, not historic type numbers. Why have things been comparatively calm this year? Well, I think that the milk production story has been the reason, one of the big reasons. But that's been changing. Milk production has been downshifting. We've seen less growth, down to plus 0.2% here in September of this year. Cow numbers down 4 months in a row. We've lost 85,000 cows over the last 4 months. And our year-over-year margin in cow numbers is down to just 27,000 head, compared to, we were up 148,000 head year over year not so long ago. And so from an environment where we've had plenty of milk and cushion against demand shocks and weather, et cetera, to a much more slender margin on milk production. And our belief is, or at least our model suggests, that we will see this lower growth for the next 6 to 9 months. You can look at the slides on your own. Zach went over these numbers. These are just some pictures of the Pennsylvania situation so far this year. So, one of the reasons we've seen less milk production is that farm margins have gotten tighter. So we saw December corn trading as high as $6.40 per bushel at one point during the planting season. And when you look at the dairy margin coverage program feed cost metric, we went from, pretty lowish feed costs last year all the way up to over $12 per hundredweight earlier this year when corn was really high, when soybeans prices were really high. And so we were way up, but we've seen some relief, right? December corn. Today we're kind of a little spicy. We're trading around 545, 550 in that market, but still well below the highs. And milk prices are in a little bit better place. Some concern though on the crop side of the ledger. There's a chance that dry areas could remain dry. This is the U.S. Drought Monitor published last Thursday. You can see the Western U.S. still pretty dry. The extreme, west of the Rockies really, really dry. Alfalfa hay areas experiencing drought. Lots of dairy areas where things are dry. And there's talk about back-to-back La Nina years. And so if that's true, some of these areas in the West that dried out in 2021 could have continued troubles in 2022. So the big question becomes, how quickly do farmers respond to what have become all of a sudden better milk prices, at least on paper, right? So the year began low milk prices, high feed prices, compressed margins. We're seeing the milk production response today. And then now we see futures trading 18 something down the road. We see corn at 450 something instead of $6 something. How does that take hold in terms of milk production response? When you look at the DMC margins that I showed before, that I showed you DMC feed costs, when you look at DMC margins, earlier this summer, when we started to lose cows, those cow numbers started going down, this DMC margin was down to 750 per hundredweight on a 12-month forward-looking basis. Well, over the past 8 to 12 weeks, we've seen that number go up to almost $10 per hundredweight here as of last Friday. So again, higher milk futures prices, lower grain futures prices, this forward-looking picture has improved. One of the things that we've always believed here at Blimling and Associates, and it's been proven true over and over and over again, is that when it comes to milk production, it always takes longer than people think for production to either respond to low prices and move up, or respond to high prices and respond to high prices by moving up, or respond to low prices by moving down. In other words, oftentimes we look at milk prices and say, the futures here 2 months out say we're at $14 milk, we're going to lose milk production overnight. And the reality is it just takes time for milk production to erode and respond to low prices. And the same thing is true on the upside. Today, we're looking at this better margins, better milk prices. And it's tempting to think, well, of course, dairy farmers are going to turn the cows right back around and we're going to see milk production increase. It doesn't usually work out that way. The reality is, I'm guessing that most of the dairy producers on this call have not seen anything that resembles like a much better milk check just yet. I think those checks are coming. We see them kind of on the horizon, but I don't think we've seen any kind of real financial healing other than this prospective healing on paper. So that's why we think, okay, the prices are looking better. It's going to take a while for milk production to resume its growth pattern. But for all that, when you look at dairy cow slaughter, we were running well above average here in the summer months around the same time that we saw these margins collapse and cow numbers start to go down. Whereas in the past 3 or 4 weeks, while these margins have gotten better over here, we've seen dairy cow slaughter ease up a little bit. So this summer, we were running close to the 5-year max on slaughter, and now we're back closer to the average. So maybe we're already seeing a little bit of response. As far as feed costs go and the crop, it turns out that we're going to have a good corn crop. The USDA's latest WASDE report said that we're going to have just over 15 billion bushels of U.S. corn production in 2021. That's way better than what we thought at one point earlier this year, and would be the second biggest crop ever. So I think that we have a lot of confidence, or growing confidence, that the crop that we're harvesting now is in pretty good shape. The harvest is going okay, but corn prices have come down off their highs, as noted. But now we're starting to really start thinking about the next crop year and some of the challenges we're facing there. There's the weather question, which we showed you with those drought charts. But we're also hearing a lot of talk about fertilizer shortages, costs, other costs going up. And when you look at urea futures, you can see the price of urea is running about double what it was earlier this year. And the same is true for other fertilizers and other inputs. Certainly energy prices are sharply higher. And so I think there are people in the marketplace today saying, wow, are we going to lose some corn acres to high fertilizer costs? There's a lot of biodiesel activity out there. Are we going to see soybean acres gain at the expense of corn there? And so while 15 billion bushels is plenty, it seems like it's better than expected. It's the best crop in a while. There are definitely concerns about next year. And I think we're starting to see those concerns price into the marketplace. When you look at today's rally in corn, the wires I've been reading have been talking about growing concerns about growing conditions for next year. Zach alluded to where farmers have been on our risk management activity. One of the things that we watch is, okay, we see milk prices are higher. Are farmers acting to lock in those prices? So far this year, futures market activity is way down 37% year to date through September at the Chicago Mercantile Exchange. And then ongoing DRP bookings, that Dairy Revenue Protection Insurance Program, we're running about 25% below year prior levels on a bookings basis through October 16th. And so I think that all the volatility last year, all the negative PPDs, all the noise in the marketplace, the back and the forth, I think that volatility certainly does create incentives to manage risk and creates risk to manage. But last year's volatility was almost too much for people, very difficult for some folks in the risk management arena. And I think we've seen people very cautious, or they've been much more cautious as they've approached the process this year. And when you're looking at forward margins in this 750 area, there's not a lot of incentive to do anything either. I will say that over the past couple of weeks, as we've seen those margins get bigger, as we've seen the forward price curve get higher, we have seen a definite pickup in activity in the futures marketplace. And it's subtle, it's hard to see here on this graph, but we've also seen a little bit of an acceleration in DRP sales nationally and certainly in our offices as producers have the opportunity to lock in better numbers. That says to me that dairy producers that are planning on being here for the medium to the long haul are looking at those 1850 futures, looking at those $17-ish DRP floors and saying, I'm going to sign up for some of that and preserve my business viability, which augurs for some milk production sustainability at some point down the road. When we look at milk production dynamics today, one of the things we follow pretty closely is spot milk prices in the Midwest. Spot milk, is not as expensive as it was. It's not as inexpensive as it was here earlier this summer. It has come down a little bit the past couple of weeks. Cream markets are tighter from coast to coast. Cream in the Northeast is extremely tight this week, from what I understand. And we've seen CME block cheddar volumes trending lower, or block and barrel volumes trending lower. And when we see that happening, typically that means there's room for upside price appreciation. Zach mentioned the inventories, cheese stocks well above historic level. They're at historic high levels in September. We have 8% more cheese in storage than we did a year ago. We're not going to run out anytime soon, according to the cold storage report. I think one thing to keep in mind with cheese this year is, okay, we've had plenty of milk heretofore, but we've also had additional new cheddar capacity come online. That came online late last year, went to full capacity earlier this year. Big cheese plant in Michigan runs about 8 million pounds of milk per day. And so that's helped keep cheese supplies elevated, relatively speaking, all year long. Demand has not been a problem. We've been talking about in the cheese market, we say cheese demand has been really good. It's just that supply has been a little bit better. Year to date through July, this is actually year to date through August, I should say. No, year to date through July, up 3.8% year over year in terms of domestic disappearance. And when we look at retail sales, you can see some strengthening. Natural cheese sales at retail have been pretty good versus 2 year ago levels. Butter stocks are a little tighter. I think this is one of the reasons we're seeing the market get excitable the past week or so. But even so, stocks declined by a bigger than average level between September and August. When we look at September butter stocks, they're below year prior levels, but this 300 million something pounds is well above what we've seen historically in September. So while less is less, we still have a fair amount of butter in storage. Butter demand, here too, the story is good. Year over year through August, up 2.3% on demand. Butter and butter blend sales at retail have been really strong the past couple of weeks. We were talking to a manufacturer marketer yesterday who said they're having a really great October. So we're a little bit behind your prior levels, but we are way above 2019. Unfortunately, fluid milk sales remain poor. Year to date through August, you can see declining sales, down 4.5% versus the same period a year ago. Fluid sales as a percentage of production through August running at 19% compared to 20.3% over the same period a year ago. I think that when you think about, there's knock-on effects to this that we'll talk about as far as revenue and federal order pools, et cetera. But one thing that grows out of this declining fluid milk market share is that the volume we lost between August of this, year-to-date August this year versus year-to-date August last year, this gap right here, that's enough milk lost to make an extra 90 truckloads of cheese or 100 truckloads of non-fat dry milk each week. I would say that cheese demand is up by about 25 to 30 truckloads a week. And our production potential, again, not that we're converting every one of these lost pounds into a pound of cheese, but the less we put in the bottle, the more we run through cheese, butter, and powder plants. And that has the potential to depress commodity pricing. When we look on the, when we look at this sliding market share of Class 1 as a percentage of overall milk production, we've seen some structural changes to how milk is priced in the United States in different regions. We've seen more regional disparities in the past 18 to 24 months than we'd ever seen before. And while last year we had this gigantic Class 3-4 spread with a big move in cheese prices to $3, and that certainly created a lot of issues in federal order pooling and pricing, the reality is when you look at areas that have heavy Class 1 utilization, we were already seeing mailbox prices versus Class 3 slip before the big wipeout in 2020. This is in New York State, 2010 to 2014, farmers were getting close to $2 over Class 3. By 2015 to 2019, that was down to just over $1. The same thing true in the Southeast, the same thing true in the Northwest. So last year was bad or was exaggerated, but it wasn't the whole story. The story about less Class 1 money and tighter margins is as much about this graph right here as it is about this graph right here. And kind of interestingly enough, when you look at the Class 1 mover situation, last year the higher of would have done a lot better than the average of, but right now the average of is actually outperforming the higher of by a little bit. And just something to think about, we are now at a point where we export more milk solids, skim milk solids, than we drink in the bottle. So fluid milk sales trending lower in terms of solids consumption, meanwhile exports trending higher. Zach mentioned this earlier, international milk prices higher lately. Milk production is sluggish in Europe. Mexico is dry, good demand in Southeast Asia. We're seeing a lot of support for commodity prices around the world. You can see here, GDT, New Zealand cheddar, up over $2 a pound. European butter over $2.50. All the non-fat markets globally are kind of bunched together at this $1.50, $1.55 area. So this is generally supportive to the US price picture. I'm not sure that we're going to export much cheese in this gap because European cheese prices are under control. Butter is tough to export, but we are competitive in the global marketplace and the environment is generally speaking supportive. What's in store for New Zealand? It's been kind of weird in New Zealand here this year. Oftentimes the big concern is dry conditions as we head into the peak milk production season. Sometime in the next couple of weeks, New Zealand milk production will hit its peak. Wet in New Zealand in many places, cool and wet, kind of a miserable spring in New Zealand. And September milk production was down 4.3% year over year. I don't usually think of too wet as a problem, but it's lingered and kind of an issue for New Zealand. We've seen GDT prices bounce up over the past several sessions. Less supply in New Zealand is certainly part of that story. When we look at European milk production, we've seen it negative in July. There were some summer weather issues with flooding in parts of Belgium, France, Germany. Environmental pressures are, they keep getting notched higher. We've seen, dairy producers in Europe have faced rising costs as well. And, milk prices are just been sort of so-so, not low, but at 36 euros per 100 kilograms. We have not seen milk prices in Europe bounce to a level that really encourages milk production. The other factor to watch is China. Always a mystery, hard to rely on the data, hard to rely on anecdotal reports. But clearly, we've seen China import lots of milk powder this year. And according to one of the tracking services, skim milk powder stocks way above normal. This represents, we think, stockpiling against supply chain issues, stockpiling against COVID issues. So China has been building safety stocks, certainly something to keep an eye on because at some point it becomes expensive. And we did see stocks come down a little bit into September. But the reality is that dairy demand in China has been extraordinary this year. The China situation has been strong domestic milk production. Milk production in China has been pretty good. We see strong imports and we see strong local prices in China. When you see all those things together, it can only mean one thing, and that's demand is pretty good. We believe that there's lots of kind of immunity type angles that marketers are playing in China, amidst the pandemic. So the China story has been a net positive for the global dairy price picture so far this year. It could be a little vulnerable if they say, hey, let's take a break on the stock situation. But on balance, China has been a solid, reliable player. So that's sort of the dairy economy story in a nutshell. I have a couple of macro slides that I do want to cover, but the bottom line for me on dairy right now is that we are going to see continued declines in milk production growth in the U.S. That should linger. Our model says we don't get really perky until April or May of next year. We are keeping score against very strong performance in 2021, and 2020 here as we go into year end. Demand seems pretty good. I think demand is going to remain good. We'll talk about that a little bit in the macro section. So I think that creates a firm-ish pricing environment, generally speaking. But I do think that the margins we're starting to see, the 1850 milk prices we're starting to see on the forward curve, the fact that farmers are grabbing onto those prices, we will see milk production growth resume and perhaps at a healthy clip once we round the corner towards the second part of next year. But we're not bearish in the short term for sure. Just turning to the overall economy, some of these slides are good news for consumers, bad news for employers, including farmers that are looking to have employees on their operations. but we are kind of an extraordinary job environment, especially considering where we were last March with the pandemic. A record number of people quit their jobs in the month of August, 4.3 million. We have more job openings than we have people to fill those jobs by a pretty wide margin. And so, the labor markets are tight. From a employee perspective, that's good news, right? Tight labor means rising wages. We've seen lots of government money come into the picture. Personal income, you can see these big spikes of government influence, unemployment benefits and other transfers as a part of income way up above normal, wages rising. So from a just at a very high level on an average basis, the average consumer in the United States is doing pretty well income wise, with government support providing a tailwind to boot. From a food aid perspective, we've seen elevated SNAP benefits this year, elevated SNAP enrollment this year. So nearly 13% of U.S. population enrolled in SNAP, getting back to levels that we hadn't seen since after the Great Recession, and critically, more dollars in consumers' pockets. Those dollars do go to dairy in some cases. There was a story yesterday in USA Today, after I put these slides together, that suggested that some of the spending is at risk because the move from $125 per person to $225 has been generated by all kinds of emergency government programs. And while the baseline benefit for SNAP is going to drop back to a higher level, there is going to be some lost dollars in this transition. The article in USA Today, I think the number they cited, or was on CNBC actually, cited a $3 billion gap in terms of consumer spending on SNAP in the months ahead. But bottom line, we had a problem, the government responded and put money in consumers' pockets. There's no way that's bearish dairy product consumption. Household net worth is in a good place, 141.7 trillion at the end of Q2, up 5.9 trillion from Q1. Lots of stock market gains, elevated real estate values. And so the average, again, this is not every household, but just cumulative net worth in the United States has been rising. The stock market's been healthy. That's on balance a good thing for consumer confidence and consumer spending power. Transportation costs are a problem. We hear about supply chain snarls every day. Trucking rates are at all-time highs. Container shipping rates are at all-time highs. And so someone's going to end up paying for this, right? It's either going to get paid for in corporate margins or in higher consumer prices or some combination of the two. And we're starting to see evidence of this inflation getting passed down the line. The producer price index looks at wholesale prices. So stuff like energy and transportation and raw material costs and labor costs that are experienced at the producer level are running 20% above year prior levels. That's extraordinary. Now, energy is a lot of it, but still way up in terms of PPI. We haven't seen anything like this in several years, if not ever. And if you look at consumer prices, they're up 5%. That's pretty stout, but there's still a huge gap between wholesale price inflation and consumer price inflation that we're going to need to solve for. Either wholesale prices have to come down, consumer prices have to go up, or some combination of the two. When we look at consumer prices up more than 5%, as I noted, through in September, food inflation is starting to perk up 4.5% in September year over year. When you do look at dairy prices in the grocery store, they are way behind in terms of growth. Meat prices are way up. Food at home inflation is up, a little bit less than restaurant inflation. But look at this energy number. Energy costs really, really high. And is it mostly about energy, right? Unleaded gasoline, highest level since 2014. I calculate that Americans are spending about 587 million more on gasoline per day this year versus last year. about $30 more per week per household. At what point does more money in the tank mean less spending elsewhere? I don't think this $30 number is a big deal necessarily, but against the backdrop of income and wages, and we've been higher in gasoline in like 2007, 2008. But then also keep in mind that heating homes is going to cost a lot more this year versus last year as well. And so as the winter goes on, if crude oil prices remain elevated, are we going to start to see consumers spending on going out to eat, on discretionary items, start to shrink because there's more dollars going to energy? Just a couple of additional curiosities. Restaurant foot traffic, you can see that as COVID retreated and the summer looked pretty good, restaurant traffic got back to above 2019 levels. Then we see the Delta variant come into play and restaurant traffic slide a little bit, but now we're back up closer to unchanged versus 2019. Restaurant visits are in pretty good shape. But this chart on the right really fascinates me. This is combined food and grocery sales in dollar terms, going back some ways. And you can see last year with the pandemic, food service sales slipped way down. Overall spending on food went down. But now we're spending about $20 billion more per month than we've ever spent before on food. Now, it's tempting to say, well, of course, that's inflation. But as I noted earlier, the inflation numbers we're seeing are running at just about 5% above your prior levels. So if those numbers are true, there's something else going on that's driving a 17% increase in grocery store and food spending. So, just a curiosity, are we eating more? Are we stockpiling food as a hedge of sorts against inflation and or supply chain shortages? I think those, and maybe it means nothing. I don't know, but certainly I find this interesting. And there's no way this is bad for dairy product demand, right? More spending on food, whether it's at home or the grocery store, is a net positive from a dairy product demand perspective. And then just lastly, when we look at the travel economy, as with restaurants, a little bit of a fade in hotel occupancy and a recovery. Airport traffic, got back above 2020 levels, pre-pandemic levels for a little while this summer before retreating a little bit. I think one of the things that we're wondering is how will business travel perform? A lot of leisure travel this summer. I think business travel is still way off. And one of the things we're seeing as a function of the pandemic is a lot more people working from home. And as a function of that, a lot more people are moving. They're saying, you know what, if I don't have to be in an office every day, I'm out of here. I'm leaving. They're leaving urban areas, going to more suburban and rural areas. But we've also seen a huge increase in RV purchases, up 56% year to date through August. So people are not just buying homes in distant places. They're taking their homes, putting them on wheels, and are working from anywhere. And while that's just sort of an interesting curiosity, I do think that when we think about dairy product demand on a go-forward basis, what are these trends in working from home and real estate say about dining in urban centers? Where we eat, what we eat, and how we eat is certainly something that we keep an eye on. As noted at the top, I do host a fun podcast in partnership with the IDFA. If you ever get a chance, give it a listen, the Dairy Download. And it's a fun show to do and hopefully fun to listen to. And that, Zach, is what I have to say, my prepared remarks for the day.
Thank you very much, Phil. I really appreciate your presentation today and being able to join us. And I've really enjoyed it, and I hope everyone that participated did as well. We did have a couple of questions come in, and I wrote down a couple as you went through as well. So we've got about 10 minutes that we'll go ahead and see how much time we have and go from there. So the first one has trucking or port issues caused problems in the dairy industry, export or locally or regionally sales? sales wise.
Yeah, I think that, look, we've done well with exports this year. I mean, we may well export a record amount of volume. So, what we've seen in terms of port traffic and activity has not been catastrophic. But I do think if you look at some of the price gaps we've enjoyed versus the rest of the world, certainly we could have exported more. And there has been lots of milk powder sitting in warehouses in the West Coast that just for want of a shipping container. And so it's not been a killer in terms of exports, but I do think that there have been times when we could have exported more than we have been able to, just because it's hard to get containers or they're very expensive. And our competitors may have been better positioned to ship from Oceania or Europe. As far as more local or domestic issues go, I think we've skated by, but back to the notion that someone's going to have to pay, right? If you're making cheese in Twin Falls, Idaho, and shipping it to Plymouth, Wisconsin to be cut and put in a package and then shipping it to New York to a consumer, you've got 6 cents per pound to 8 cents per pound of additional cost just in trucking this year versus last year. Well, that's 80 cents a hundredweight of milk, right? I mean, again, I'm not saying that dairy farmers are going to pay for that directly, but that's a lot of money that someone's going to have to pay for, and maybe the consumer will ultimately pay. So I think there's that issue, and milk hauling, tanker freight has been crazy expensive for lack of drivers and lack of equipment, all the things we're seeing elsewhere. And at some point, someone's going to pay for that as well. We've not gotten to a place, I hear things occasionally like, oh, there's extra milk in Wisconsin, but we can't get it to Michigan or whatever. There's trouble moving stuff around because of transportation. But I don't think it's created any real. It's created a lot of sleepless nights and headaches and additional cost. I don't believe it's hurt. We've not had to dump a lot of milk because it couldn't get moved, kind of thing.
Okay, thank you for that answer. The next one actually came in on Facebook. Said that the question was asked, or statement was made, and then a question asked that the 2021 DRP purchasing openings is basically over. What does the 2022 purchase graph look like?
Well, it's I follow those statistics quite carefully. So if you just bear with me for 1 second, I'll give you the exact number. So that chart that I showed you was a graph of actual bookings. So that's like the week that we placed them, the week that the business is booked, not the period where the business is sitting in. So there's still time to go, obviously, in terms of that booking. For next year, give me 1 second here. Okay. I'll even show you where we are. Give me 1 second. Yeah, when we look at it this way, where's my Zoom screen? Give me 1 second here. Here we go. Zoom, share screen, DRP. These are the statistics by quarter. So when you look at 2022 placements, if you will, through this is a week behind. So we are at 23 billion pounds of effective coverage, 17.5 billion pounds of declared coverage placed in 2022 so far. So those numbers are running 60% below 2021 placements, if you will. And one of the reasons is, the insurance has gotten expensive, right? I mean, this is the gross premium, not the net premium, but, with volatility has come higher insurance premiums. And so, the average the average 2021 contract costs 70 cents gross. And right now, what we've booked nationally for 2022 has been 81 cents gross. So it's a more expensive product today.
Well, that basically answered one of the questions that I was actually going to ask. You covered in that, and that was the premium. Do you think premium costs are reducing the usage in these products? And so your short answer would be yes, that it is. Sounds like
I mean,
it.
it's like
Yeah,
anything else, right?
Yeah, they're quite pricey when you go to look at it, costing 30 or 40 cents to lock in a price for. It's kind of scary to want to spend that much money. And I understand,
and I think it's scarier yet when you're seeing, nearby margins compressed, right? And while there was some DRP indemnities for Q2 and Q3, they were not huge. And so, you have, a shrinking financial picture in front of you, right, real time. And, being asked to spend more to protect, the future, it's a little bit dicier proposition. I will say, though, that the past couple of weeks have been, the activity has picked up quite a bit. And I don't think it's an accident that, that's happening at a time when the prices are going, the coverage levels are going higher.
Another question I wrote down is you showed the slide then that US Deck put out I saw it on US Deck webpage where exports have surpassed Class 1 sales. How do you think with the push for milk marketing order reform going on, how do you think if that relationship continues, how do you think that that'll play into any price calculation changes or any reform that we might see?
Well, I think that, we've spent a lot of time, money, and energy fighting over Class 1, right? Historically, Class 1's been the prize. And of course, those, there's fewer Class 1 dollars to go around, which is creating some of the issues out there. I just think that from an export perspective, one of the things that we keep finding when we talk to people and the work that we do around the topic is that we need to export more. And there are elements of our pricing system that create competitive complications from an export perspective. And so, do we need a special export class of pricing or some sort of allowances or some sort of acknowledgement? I don't know. I'm not smart enough to know the specific fixes or answers, but my hunch is, hanging around policy circles a little bit, is that we will definitely see, it's going to have to be part of the conversation, because, as fluid sale, if we're going to grow milk production, we got to grow exports. It's pretty much that simple. And then, do we have a system that helps us do that well, or can we tweak the system to make our export competitiveness even better?
Okay, thank you. That's. I don't see any more questions in the chat box. If there are some last minute questions, go ahead and chat them. I'm going to share my screen one more time and just go ahead and sort of close things down. But we are the next Protecting Your Profits webinar will be next November 24th. 2021 at noon, and that'll just be the regular USDA reports, a lot similar to what I covered, but maybe a little more in depth since we won't have a guest speaker at the beginning of the webinar. And with that, thank you. I'm going to check the chat box one more time to see if anything else came through, and it doesn't look like it did. So again, Phil, thank you very much for joining us today. Really appreciate your presentation, and thank you everyone for joining in and participating today on today's Protecting Your Profits webinar. And I will look forward to talking with you again next month. Thank you and have a great rest of the day and rest of the week.
Thanks, Zach.